Welcome back to Investing Talk Podcast.
Today we're looking at WeRide. The big question is it a good time to buy now?
We want to hear from you. Subscribe, like, and comment to support the show. And if there's a specific company you want us to look into, leave it in the comments below.
So let's get into the analysis.
Okay, WeRide. They're a pretty big name in this whole autonomous driving race, wouldn't you say?
Definitely a major player. And what's interesting is they're not just doing robo-taxis. They've got robo-vans, robo-buses too.
Right, that multi-platform thing.
Yeah.
And they're operating, where is it? Nearly 30 cities.
Yeah, across 10 countries. So a really wide footprint already. That global reach and the mix of vehicles, it does kind of set them apart from some others who are maybe just focused on, passenger cars.
And that presence is crucial when you think about the market size we're talking about here.
Oh, absolutely. The global robotaxi market itself is projected for just, explosive growth. We're talking like a 69% jump expected just from this year to next.
69%. Wow.
Yeah, from about $1.19 billion to over $2 billion. And that's just robotaxis. The whole autonomous vehicle sector could be over $2.3 trillion by 2030.
That number is almost hard to grasp. It really hammers home that this is still the early days, the land grab phase, right?
Totally. They're not just fighting for today's dollars. They're staking out territory for tomorrow.
And they got a huge signal boost earlier this year, didn't they? With NVIDIA.
That was a big one. When NVIDIA revealed they'd taken a stake, the stock more than doubled.
Which really shows the market sees that as a major tech validation.
Exactly. It's more than just a thumbs up. Really, the whole bull case for WeRide kind of hangs on these strategic partnerships, with NVIDIA providing that tech backbone.
Okay, let's dig into that. What do these partnerships actually let them do?
So NVIDIA is providing the core tech, their Drive AGX Hyperion 10 platform. It's not just a chip, it's the whole system, sensor, software, everything you need for
level 4 autonomy.
Precisely. Level 4 or L4. And that detail, L4, that's absolutely critical for investors to understand.
Why L4 specifically?
Because L4 is where you potentially hit profitability. It means the car drives itself under certain conditions, and crucially, you can take the human safety driver out.
Ah, the driver costs. That's the big operating expense, right?
It's the biggest one by far. So by aiming for L4, using NVIDIA's certified gear, WeRide is basically saying we're targeting cost efficiency from the start.
Okay, so NVIDIA is the tech muscle. Then you've got the mobility giants they're working with, like Uber.
Right. Uber's heavily involved. They put in another $100 million, and the plan is pretty aggressive. Roll out in 15 more cities in the next 5 years.
And how does that partnership work? Who does what?
It's basically WeRide providing the brains, the L4 tech and software. Uber handles the cars, the operations, the customer side.
That's an asset-light model for WeRide then.
Exactly. Uber takes on the fleet management risk. WeRide avoids massive upfront costs on vehicles and logistics. It lets them scale much faster.
Does that create issues, though? Like less control over the actual service quality compared to someone who owns everything?
That's the trade-off, yeah. You give up some control for speed and scale. But right now, with the focus on global expansion, it probably makes sense.
And Tencent is involved, too.
Particularly in Asia on the customer side, Tencent Cloud helps speed up their commercial launches, integrating WeRide into things like WeChat's transport platform. Huge user base access there.
Tech, fleet ops, customer base. Sounds like they've got the pieces covered with partners. So the proof has to be in the real world rollouts.
And they have been getting wins there, especially outside China. The Middle East is a key example.
Right. Riyadh, they launched public robotaxi services there.
Yeah, and it was the first public AV service on Uber in Saudi Arabia. That's a big deal. It shows the tech works in different environments, different regulations. Followed their earlier launch in Abu Dhabi, too.
And Southeast Asia, Singapore.
Yep, Grab is investing and partnering for Singapore. And it's not just taxis. They're doing an 11-vehicle robus fleet there starting early 2026. Shows that multi-platform strategy in action.
Okay, so buses for set routes, taxis for on-demand. Makes sense.
And all this real-world stuff, it's starting to show up in the numbers. This is important for the bulls.
How so?
Their specific robotaxi revenue, it jumped, wait for it, 836.7% year over year in Q2 2025.
Whoa, okay, that's significant.
Right. That segment is now over 36% of their total revenue. It shows the commercial side is really starting to kick in, not just R&D projects, and the fleet's over 1,200 vehicles now.
That growth is probably why analysts are keen, but The stock's down roughly 30% since the start of the year, so the market's clearly seeing risks too.
Exactly. Even with those wins and the recent 15% bounce on partnership news, there's still a lot of caution around the whole sector,
Yeah.
mainly because of the lack of profits right now.
Which comes down to the cash burn, right? All that R&D and expansion costs money.
A lot of money. They lost $53 million net in Q1 2025 over the last year. It's nearly $339 million in losses. That's a serious burn rate.
So profitability is...
It's always off, as the analysts tend to say. But the revenue picture itself is interesting. Remember, Q1 growth was really slow, just 1.8% year over year.
Yeah, 1.8%, then that huge jump in Q2. 60.8% growth. Why the massive swings to bad quarter?
It actually shows a transition happening. Early on, AV companies get steady money from R&D contracts with partners. Predictable, but maybe lower ceiling.
Okay.
As they shift to commercial revenue, actually charging people for rides, the numbers get way more volatile, but the potential upside is much higher. So slow Q1 might mean phasing out some R&D work.
And the big Q2 jump means those commercial launches, like in the Middle East, are really starting to generate cash.
Exactly. You have to expect some bumpy numbers in the short term if you're betting on the long game here.
That makes sense of the revenue swings.
Yeah.
But the overall sector is still shaky. What was surprising, though, was seeing that weekly price volatility has actually decreased from 20% down to 10%.
Yeah, that suggests maybe the bigger institutional investors are stepping in, finding a floor price.
Why would they do that with the company still losing so much money?
They likely see the losses as necessary investment in tech they believe is inevitable. They're probably accumulating now because they see catalysts coming up that could justify a higher price. They're betting on the future potential.
Which leads us nicely into what the analysts think. Despite the losses and the stock drop, the consensus is...
It's a strong buy. Pretty definitive, actually.
And the price target?
Average target is around $22. With the stock near $11 now, that implies, anywhere from 50% to over 100% upside.
That's optimistic. So they must be banking heavily on future events, these catalysts.
Absolutely. That target isn't based on today. It's based on what they expect to happen soon.
Okay, let's run through those. What's the biggest near-term thing?
The HKEX dual primary listing. That's set for November 6th. And it's got big backers, Uber, Grab, Bosch are anchor investors.
Why is a Hong Kong listing so important? Just access to more capital?
That's part of it. Yes, access to Asian investors. But maybe more importantly, it's a strategic hedge. A primary listing there offers significant protection against potential geopolitical risks, like delisting from U.S. exchanges. That's been a big worry for Chinese tech firms.
Right, so it's a de-risking move that could definitely help the stock. What's next?
Soon after that, we get Q3 earnings expected around January 10th next year.
And the expectation there is?
Accelerated revenue growth. Analysts want to see those recent commercial launches in the Middle East and China really driving the numbers higher year over year.
So proof that the strategy is translating into real revenue.
Exactly. Operational validation.
And then there are the rumors. Always rumors with these kinds of stocks.
Right. You hear chatter and forums, that sort of thing. Two main ones floating around. First, potential new deals with car manufacturers, OEMs, maybe in Europe or the US. That would be key for fleet expansion.
And the second?
Talk about a possible strategic investment from the Saudi Public Investment Fund, the PIF. Given the Riyadh launch, it kind of makes sense they might be interested.
Okay, need to stress, those are just rumors for now, unconfirmed. But a PIF investment would be huge, a massive vote of confidence in a ton of capital.
Absolutely, a huge geopolitical signal too.
So we've got the bull case built on partnerships and expansion, the bear case focused on cash burn. What's the biggest single risk that could derail this whole thing? Prevent them hitting that $22 target?
For me, it's less about the money right now and more about safety or regulation.
Like a major accident involving one of their L4 vehicles.
Exactly. One bad, high-profile incident could cause regulators worldwide to slam on the brakes, delay approvals, and completely wreck the timeline to profitability, which is already pretty tight. The market's betting everything on that L4 tech being safe and reliable.
Okay, so putting it all together for someone considering an investment now.
Look, WeRide is definitely in the thick of the global robo-taxi race. They've got powerful partners backing them with tech, money, and users. But you have to accept the reality. It's a long-term play. Profitability isn't around the corner. Patience is needed.
So if you really believe L4 driverless tech is the future and you can handle the ups and downs, the volatility, then the analysts certainly see a lot of potential upside from where the stock is now, especially with catalysts like that HKEX listing coming up.
The key question for you is, do you weigh the current operational success and expansion more heavily or the significant losses needed to achieve it? Right now, the market seems tilted towards the potential, assuming you can wait out the burn phase. Knowing that the road to profit runs through places like Riyadh and Singapore, well, that's the real takeaway here.